Well, as we turn our attention to equity markets, we'll start off with market organization and structure, just an overview of the financial system, the goals of the financial system, and some terminology and some definitions to get you ready for the rest of your study of equities markets. So for the overall financial system functions, we've got 3 points here. Allow entities to borrow, others to save, to issue equity, manage risk, exchange assets, and utilize information as it arrives to the marketplace. And the financial system, one of the functions is to determine the returns that equate savings and borrowing. At a point in time, some people in the economy, some organizations in the economy are savers, and some are borrowers. So a new company is borrowing or raising money through issuing equities, and on the other hand, people that are saving for retirement are looking to invest their money. So this overall mechanism determines the returns that balance this out, create an equilibrium between savings and borrowing or equity investment across the economy. And one of the real goals of a well-functioning financial system is to allocate capital efficiently. And that means we want savings to be channeled into its highest valued uses. Some definitions here when we say an investor expects to earn an equilibrium, fair rate of return over time, whether it's an investment in debt or an investment in equities or other alternative investments. We refer to an information trader, and that's one who expects to earn a positive risk-adjusted return. That is, they're using information, hopefully to gain an edge and be first to position themselves for an increase in value. A hedger, on the other hand, has an existing risk and takes on a position to offset that risk. Like a wheat farmer who has to sell wheat come harvest time can sell wheat futures to lock in that price of wheat at harvest time and reduce their wheat price risk. Farmers have a lot of risks to face, but wheat price risk for a wheat farmer is key, and they can hedge that through the financial system. Some more definitions here: financial versus real assets. When we're talking about stocks, bonds, any types of securities, these are all financial assets. Real assets have a physical presence, so gold is a real asset. A factory is a real asset. A hydroelectric plant is a real asset. And debt versus equity securities. Well, debt is typically bonds, but could just be a straight bank loan, whereas equity securities give investors an ownership interest in the company, and they participate in the results of that company. For whether they're good or whether they're bad, they're an owner, and they're participating in that. And, of course, debt holders have a priority of claim. Excuse me. Debt has to be paid off before dividends can be paid to the owners of equity securities. And public versus private securities. There's lots of corporations in the world, and many of these corporations are privately held. Okay? When we talk about public securities, they've been registered with the securities regulators of whatever market that they're in, and so they're available for trading to the public. Okay? And so there's real differences in a public company and how much money they can raise for their growth and things like this. Private corporations are more limited in that aspect. And in terms of price discovery, public securities, for many of them, we see them trading every day, and we know at least what the combined wisdom of the markets is about what they're worth. With private securities, valuing those can be very difficult, at least more costly. And physical derivatives versus financial derivatives. Well, a derivative is a security that value is derived from the price of some other current or some other asset or a currency or an interest rate. And so a physical derivatives would be a gold futures contract. And financial derivatives would be, and as an example, a call option on the shares of a gold mining company. That would be financial because it involves the shares rather than the physical asset, the gold. Some of our terminologies for the classification of different markets. Spot markets are just markets for immediate delivery. So if we're talking about the spot price of euros in dollars, that's the price in dollars that you would pay to buy euros for delivery right now, immediately. Futures markets and forward markets have delivery dates in the future. So I might enter into a futures contract on gold. And if it's 90 days futures contract, what it does is establish the price for a transaction of buying gold with delivery 90 days from now. And primary markets refers to newly issued shares. And so a new issue of stock by an existing corporation or a corporation that has an initial public offering shares to the public for the first time, those are primary market transactions because the buyers of those shares, the money goes to the company, not to a prior owner of the shares. Now, secondary markets, on the other hand, are where they trade after they've been issued. So trades in the secondary market are for securities that have already been issued and are owned, and so when you purchase those, the money's going to the seller rather than to the issuer, to the company. Same with debt securities. The U.S. Treasury is issuing new debt, issuing new Treasury bonds or Treasury notes, then that's a primary market transaction. If you go later on and buy a Treasury bond from a bank, from a brokerage house, that's a secondary market transaction. And call versus continuous markets, well, most of what we run into in developed markets, of course, is continuous markets, where the trading takes place continuously during the hours that the market is open. Call markets, on the other hand, this system is used in less developed markets where there's not a lot of liquidity. So maybe a buy order will show up and a sell order will show up sometime later. Well, this could lead to a lot of price volatility. So what they do is they accumulate buy and sell orders over a period of time, and then at specified times they choose a price that's going to balance out supply and demand. So try and find an equilibrium price based on the orders that have accumulated up to that point in time. Money markets refers to securities with maturities of a year or less. So these are debt securities with a year or less of maturity. And so Treasury bills are money market securities, for example. Capital markets refers to securities with maturities of greater than a year, or in the case of equities that don't have a maturity date, okay, just no maturity date at all. So it really has to do with the timing. Traditional markets versus alternative investment markets. Well, traditional markets, think of stocks, think of bonds. Okay. Alternative investment markets, we're talking about private equity, we're talking about hedge funds, commodities markets, okay, futures markets. So really just think stocks and bonds versus all the other alternatives that are available. When it comes to types of assets, we've got equities, fixed income securities, and pooled investments on this slide here. Well, equities, that's the ownership stake, right? If you own some shares in a company, you own a portion of that company. And you get the gains or the losses, depending on how the company does. Fixed income securities refers to debt markets broadly. And fixed income securities have priority over equity securities. Okay? They're paid first before dividends can be paid to equity owners. Pooled investments, we've got 4 examples here: mutual funds, exchange-traded funds, asset-backed securities, and hedge funds. And we'll cover these all in more detail as we move through the equities curriculum. But mutual funds, this is including REITs, that's real estate investment trusts. And the pooling in a mutual fund is that the mutual fund buys several securities, like an S&P 500 index fund could be a mutual fund. The REITs, the real estate investment trust, Well, they buy a portfolio of properties and manage those properties. They could be income-producing properties, they could be farmland that produces income, or they could just be investment properties that don't really provide a current income. Exchange-traded funds, close to mutual funds, but just a little bit different structure. The exchange-traded funds trade on well, an exchange, of course, but they trade like stocks. Now, some mutual funds trade like stocks, so there's some key differences in the creation of new shares and the redemption of shares. Many mutual funds stand ready to do that. Some that traded on an exchange are called closed-end mutual funds, so they don't have money flowing in and out. Exchange-traded funds have a system of money flowing in and flowing out that's designed to keep their trading prices very close to the net asset value based on the market prices of the holdings in there. Asset-backed securities refers to securities that are backed by financial assets. So don't confuse that with the collateralized securities where there's some assets, say a firm's holding of equipment, railroad cars, for example. That would be a collateralized debt. When we say asset-backed, we're talking about financial assets. So it's a pooled fund of financial assets, perhaps mortgage securities are asset-backed securities, pools of those. And so from that pool, the payments on the financial assets, the cash flows on those, are passed through to the owners of the asset-backed securities. And hedge funds are pooled investments, but much more latitude in what they might be doing, not just stocks and bonds, not just long positions, but short positions, taking an activist position, using a lot of derivatives, speculating on foreign currency, exchange rate changes. All of these come under this general heading of hedge funds. There's a lot more flexibility and variety in their investment strategies compared to these others. Currencies, of course, are a type of asset. Contracts, we mentioned forward and futures. We'll also look at swaps, where two interest rates are paid, one by one side maybe paying a floating rate of interest and the other side paying a fixed rate of interest, for example. Options that are derivative securities. They give the owner the option to buy at a particular price or to sell at a specific price sometime in the future. Commodities, well, commodities are real assets. If we refer to wheat as commodities, rice, and more broadly, sometimes we refer to precious metals, gold, platinum, silver as commodities. And real assets are your physical assets that not necessarily produce something, I guess, because farmland or just undeveloped land could be a real asset, gold, a factory, things like this. So before we differentiated these from financial assets, so that's the key. Within the financial system, we have various types of intermediaries. So let's just look at some definitions of these terms here. Brokers connect buyers and sellers of the same security at the same location and time. Well, that's a pretty long way to say it, but when you think of a broker, think of a go-between. If you say, well, a real estate broker. Well, a real estate broker typically doesn't own the real estate, right? There's something for sale, they're going to find a buyer. So they're a go-between. So that's the idea here of connect buyers and sellers of the same security. Dealers, on the other hand, maintain an inventory. So you can think of, at least outside the financial world, a used car dealer. They buy cars and then they sell those cars. Okay? So it says here, match buyers and sellers of the same security at different points in time. Well, with a car dealer, they buy the cars and then they sell them at a different point in time. They sell them later. Okay? And in the securities markets, if you think about bonds, rather than being a broker, just matching up a seller of bonds with a buyer of bonds, dealers maintain an inventory of bonds. So they buy for their own account and then they sell for their own account. Arbitrageurs. Well, our official definition here, or explanation, is transact with buyers and sellers of the same security at the same time, but in different markets. The idea of pure arbitrage is that if there's a difference in price between two things that are essentially the same in their future payoffs, then they want to buy the low one and sell the high one, okay, and just capture that difference. And the function of arbitrageurs is if we've got two things that are essentially the same in terms of their future payoffs, then they should sell at the same price. And arbitrageurs can act to ensure that that's actually the case. Buying the low price ones, drive that up. Selling the high price one, drive it down, until there is approximate equality of prices to where it's no longer profitable to enter into these arbitrage transactions. Securitizers and depository institutions sell interests in a diversified pool of assets. Well, when we talk about depository institutions, we're talking about banks. So we have deposits going into banks. What's the pool of assets? Well, it's the loans that banks make, investments in securities that the banks make. And so they're managing the overall risk and promising a return to depositors. Securitizers take financial assets and put them into a pool and then issue securities against them. So this is related to asset-backed securities that we spoke about previously here. So if we had a lot of mortgage securities, a lot of mortgages, we can take those individual loans, those individual mortgage loans, and put them into a pool and then sell securities that represent a slice of that pool. So a slice of that pool, and so they get the interest and principal payments, or at least their proportion of it, from this pool of mortgages that underlies that. Insurance companies manage a diversified pool of risks, so no surprises here. If they're issuing auto insurance, everybody pays in their premiums, and there's a pool of risks, and when they have accidents and insurance payoffs are made, and they use the premiums for that. Clearinghouses reduce counterparty risk and promote market integrity. Clearinghouses can stand behind both sides of a trade, and we see this in the options market, we see this in the futures market. So if I enter into a futures contract that says, okay, you're going to sell me gold 90 days from now at $1,226 an ounce or whatever it might be, I don't have to worry. Counterparty risk is the risk that the other side of the trade that promised to sell me the gold, if I promise to buy the gold, won't perform. So the clearinghouses stand between both sides. And so they guarantee performance of the contract. And so I don't have counterparty risk. I'm really dealing with the clearinghouse.